Today, we are going to unpack a massive economic story that's playing out right now in the Gulf Cooperation Council, or the GCC. And what's interesting is that it's a problem so huge that it's actually created one of the biggest opportunities in the entire region. So let's just put a number on it right away. $250 billion. That is the size of a financing gap that small and medium-sized businesses are facing all across the GCC. I mean, think about that. These are the very companies that are supposed to be building the future, but they're being starved of the cash they need to actually grow. So, this brings up a really big question, and it's one we're going to dig into in this explainer. Is this gap just a massive, unfixable failure of the traditional banking system? Or is it actually the single greatest opportunity for a whole new generation of companies to step in and build the future of finance? Let's find out.
To really get a handle on the opportunity, we first have to understand the sheer scale of the problem and, why the very engine that's supposed to power GCC economies is in danger of stalling out.
The key words to focus on here are central and non-oil growth. See, these small and medium enterprises, or SMEs, they're not just some small part of the economy. They are the absolute centerpiece of every major national plan, from Saudi Vision 2030 to the UAE's big diversification push. They're meant to be the main engine for creating jobs that aren't tied to oil. Okay, so if these SMEs are so vital, what's the deal? Why can't they get the money they need? Well, it really just boils down to a fundamental mismatch. You've got old-school lending trying and failing to serve new world business. And this slide just lays out the disconnect perfectly. On the left, you see exactly what a modern small business needs. They need fast, flexible access to working capital, and often for, relatively small amounts of money. But then on the right, you see what the banks are built to offer. Huge loans, super slow and rigid processes, and a cost structure that makes it not even worth their time to process smaller financing requests. And just look at this timeline. I mean, it's almost unbelievable. A typical loan approval can take anywhere from 8 to 12 weeks. In today's world, a business opportunity that was there in week 1 is ancient history by week 12. This speed, it just doesn't work for a business that's trying to manage its inventory or lock in a new supplier. So what's the direct result of all this? A staggering 63% of these small and medium businesses say that pressure on their cash flow is their single biggest barrier to growth. Think about that. They aren't failing because they have a bad product. They're struggling because the financial system just isn't built for them. But, a problem this big creates a vacuum, and a vacuum this big creates a massive opportunity. This gap has basically paved the way for a whole new industry to just explode onto the scene, which brings us to Fintech's incredible growth spurt. And the numbers here are just, wow, they're phenomenal. The fintech sector in the Middle East and North Africa is on track to grow at 35% a year. Now look at that comparison. That's more than double the global average. This isn't just a little trend. It's a major structural shift in how finance is done. And this chart here shows us exactly why there's so much excitement. Right now, fintech only has about a 2% slice of the total banking revenue pie in the GCC. Compare that to 5% in places like the US. What this really tells us is that the runway for growth is absolutely massive. Just look at all that untapped potential. So here's the crucial question. How are these new companies succeeding where the big traditional banks have failed? Well, they're doing it by building totally new digital-first financing models that are designed from the ground up for the speed of modern business. One of the most powerful new models is something called asset-based financing, and it's a simple but totally brilliant idea. Instead of just looking at a company's bank statements, lenders can provide financing that's secured against things the business already owns, like its inventory sitting in a warehouse or its customer invoices. It literally turns dormant assets into cash you can use. Another game changer is revenue-based financing. This model is absolutely perfect for businesses where sales go up and down, like e-commerce or retail. Repayments aren't some fixed amount every single month. Instead, they adjust to be a percentage of the company's actual revenue. So when sales are great, you pay back a bit more. When things are slow, you pay back less. It's a financial shock absorber. So what's the secret ingredient making all this possible? Well, it's technology. It's the whole secret sauce. These new companies are using digital underwriting, they're plugging into open banking data, and they're using automated decision-making to figure out risk in real time. And that's what slashes the approval process down from months to, in some cases, just a matter of hours. This whole shift is so profound that we're not just talking about a new product. This is an infrastructure-level opportunity. So let's break down the key takeaways for all the different players in this ecosystem. All right, for any founders who are listening, the message here is crystal clear. Don't just build a nice-to-have feature. Build essential infrastructure. Go after the sectors that are feeling the most pain. We're talking logistics, e-commerce, construction, and build rock-solid systems that can handle a ton of transactions and can assess credit really, really intelligently. And for investors, that 35% growth number should be music to your ears. But this isn't just about chasing a hot trend. It's about putting capital to work to solve a deep structural economic problem. And by doing that, you're not only setting yourself up for strong returns, but you're also directly fueling the national diversification goals of the entire region. And finally, for the policymakers, this financing gap is a major economic bottleneck. To really open the floodgates for growth, the focus has to be on encouraging things like open banking to get data flowing, improving the quality of credit data, and building supportive regulations that let these new innovative models scale up responsibly.
So what's the big takeaway from all of this? It really boils down to this one powerful idea you see on the screen. The ambitious future that the GCC is building for itself depends entirely on having a financial system that can actually keep up. That $250 billion problem, it isn't just a challenge. It's the catalyst that's forcing the creation of a whole new layer of economic infrastructure, one that finally lets the region's most important businesses grow at the speed of their own ambition.